Today's episode is brought to you by Lightyear, the investment platform I use for my stocks and shares ISA. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
No one likes to lose money, and some funds are designed to deliver a positive return whether markets go up, down, or sideways. It sounds easy, doesn't it?
Today we're joined by Jasmine Yeo, fund manager at Ruffer, to discuss the art of capital preservation. And in today's dumb question of the week, if markets usually go up, why spend so much time thinking about what could go wrong? All right, let's get into it. So we're delighted to be joined by Jasmine today, who is, I believe, Ruffer's youngest ever fund manager. When I looked you up, that's what it said.
Badge of honour, thank you.
So I guess the first question I have really is that when you think about what it means to preserve capital, what it means to not lose money, there's several things you could benchmark against, like the cash rate or alternative strategies. How do you think about it at Ruffer? What does it mean to not lose money?
Yeah, so the Ruffer philosophy, which has been the same actually since we started the firm more than 30 years ago now, it's very simple, but I think it's pretty powerful, as you say. It's not to lose money. And I remember thinking when I first joined the industry, how is that an aim? How is that unique? Because surely everybody's trying to do that. And quite quickly learned that that isn't the case. Most people in our industry are paid to perform relative to something like a benchmark. And I think that sounds pretty logical. If you're paying a professional, you want to use a yardstick. You want to know how they're doing. How do you measure against that? But we think that the issue with things like benchmarking is, well, firstly, it kind of puts the onus back on the investor to choose the right yardstick. But maybe the bigger problem, it sort of creates a setup whereby if the market falls, say 20%, and your benchmarked fund manager only falls 10%, then they've done their job, right? Technically, they've outperformed the market. But the reality for the investor or the client is they've still lost 10% of their savings. And it's really that observation that led Jonathan Ruffer to set up the firm and to offer an alternative to that industry approach of benchmarking. So when we say we don't lose money, we're not talking about those relative returns or versus a benchmark. It's really talking about protecting investors in absolute terms. And most importantly and crucially, that's through periods of market stress and the sort of drawdowns that really start to impact and destroy the power of compounding.
So how would you see Ruffer being held inside a portfolio? Is it a kind of side holding, a kind of pocket, which kind of protects the core of the portfolio? Or do you see it as being a very large holding, which forms a central part of a portfolio?
Well, really, we do one thing, but we have lots of different types of investors and clients that use us in many different ways. And I think both of the ways you described can suit a portfolio with a slice of Ruffer in it. I think all portfolios, and I would say this, but I think it's the case, could benefit from having a piece of Ruffer, given typically we do deliver an uncorrelated return. So uncorrelated to the equity markets, which is very helpful, as I say, through periods of market stress, offering that protection within a wider portfolio, but also, perhaps more importantly, more recently, also an uncorrelated return versus things like fixed income and bonds, which have had a more difficult time in recent years. So it can be that sort of diversifying role. But of course, because our main objective and our absolute focus is on that capital preservation piece, you do see some investors use us in much greater size, where those aims and those objectives really chime with what they're trying to do.
And how do you handle the fact that, I guess it's inevitable that a capital preservation fund will lag behind like the equity market in a bull market? Do you see investors like doing the wrong thing at the wrong time because of FOMO?
Yeah, I think it's a strategy like this. It's definitely fair to say there can be more uncomfortable or tricky periods where our returns might look different or a little pedestrian if we're sort of in the throes of a bull market, as you say, those periods where FOMO can be really quite acute and painful. But I think there's sort of two benefits really of this type of approach. The first one is it can outperform equity markets over the fullness of a cycle. So thinking about the bull market, but also the more difficult periods, avoiding those severe losses, so say keeping that power of compounding on your side can be really, really powerful for a long-term return. We all know sort of the adage, if you lose half of your money in one year, you need to make 100% the next year just to get back to zero. And that's really, really difficult. So capital preservation, I think, if done successfully, can be very powerful and deliver those even better potentially long-term returns. And a big part of that as well comes from the opportunity set that it creates. Because, of course, if you've held on to your money through a period of market stress, then you can be a buyer perhaps when others are most fearful. The second element, as you point to, is sort of the psychology, or I guess the behavioral element for investors. It's much, much easier to stay invested when the journey is smooth, and equity markets can be quite the roller coaster ride. There can be a lot of volatility, and as you say, that can drive poor behavior or selling it at just the wrong moment. So something that can achieve that steadier return profile, miss the kind of really severe lows, then it can help investors stay the course, and that is an important determinant of the long-term return.
Now, one of the things I'm sure you're always thinking about is carry, because if you do have protective positions, say through the derivatives market, then you're having to pay a premium, and that's a drag on return. Now, when everything's fine, those premia are usually quite small. But when things get rough, obviously the cost of the premium rolling it becomes more expensive. So some hedges generate income, some of them are a cost. So how do you generally think about that?
Yeah, so I guess we're a little unusual, or something that makes the portfolio a bit different at Ruffer is the fact that we do use things like derivatives. And I think that's one of the big benefits of the fact that we're unconstrained. We have that flexibility and wide toolkit. And I think that's really important today, given, as we sort of touched on with bonds, the less conventional source of protection, I think, will be necessary to achieve diversification and capital preservation going forward. So that's why we do it, I suppose. To the point on the cost, yes, absolutely. It's a frustrating and I guess complicated type of investment to allocate to, these derivatives, which work, much like insurance policies. You've got to pay that premium, as you point out, because there is that cost. But that's where it becomes very important to be dynamic and flexible with the types of protection that we're using here. So what we're not doing is sort of repeatedly allocating to the same type of protection, whatever the cost. And as you point out, as volatility picks up, as investors become more worried, different types of protection cost different amounts and sometimes get very, very expensive. So the ability to move through different types of hedges and protection is really vital. I think spending a couple of percent a year on effective protection is very worthwhile, and if done well, can be very impactful for returns. For us, that was years like 2022. Bonds and equities fell together. We delivered a positive return thanks to this part of the portfolio. And the other way that we can kind of think about managing those costs, as well as being dynamic and searching kind of the most mispriced opportunity, is doing it within a portfolio of offsets. So if you were to do this in isolation and that protection wasn't required, it is going to be very painful and costly. But in our portfolio, we'll always look to own a mixture of growth and protection. So whilst we might have one part of the portfolio like this costing, if those risks don't appear and that protection isn't required, but then importantly, on the other side of the portfolio, there should be growth assets, typically equities, but it can be other things like commodities, precious metals, that should be allowing us to deliver a positive return in the meantime. And 2025 actually was a really good case study for that. So the moments when markets wobbled, April, Liberation Day, you saw a very sharp drawdown in equity markets. And it was these types of hedges that were working for us in that environment where bonds were falling, and actually the dollar fell through that period as well alongside equity. And then through the rest of the year, as equity markets recovered, we were able to continue delivering that positive return thanks to other elements of the portfolio like the equity and the precious metals.
You briefly mentioned 2022 there, which for your ordinary retail investor was kind of like the nightmare scenario, right? Equities did really badly. Bonds did not hedge it. Bonds did just as badly, really. Now that yields have risen since then, do you think bonds offer diversification and a hedge at all, or is that just gone out of the window?
So I think they're definitely not the safe haven that they once were. That started in 2022, but actually there's been a positive but also quite volatile correlation to equity markets since. And I think that is reflective of a regime shift that investors are now having to kind of grapple with. And in part, that is driven by inflation, and that's what we saw in 2022, but also, perhaps more importantly, inflation volatility. So through periods of high and rising inflation, bonds are going to be very unhelpful. But exactly as you point out, there are going to be other moments where bonds are very helpful, and through periods of disinflation. And I think what was interesting to see this year through the volatility in equity markets, concerns around AI disruption, driving disinflationary concerns, you have seen bonds be protective within portfolios. So that's all to say, we think it's not the buy and hold asset that it once was. I don't think investors can build a balanced portfolio of bonds and equities exclusively and rely on that in the coming decades in the way that they perhaps did in past decades. But at the same time, bonds will have a role to play. We just think it will be a more tactical one, and maybe they should be thought of a little bit more like a risk asset as opposed to a buy and hold protective asset like it was in the past.
Now, I know that one of your ideas at the moment is to have inflation-linked bonds. And as I understand it, they protect you against unexpected inflation. So clearly, if you have just a normal government bond, it bakes in some break-even inflation into the bond. But that's based on expected inflation panning out as markets expect. But if you have unexpected inflation, that's where the linkers help. So presumably that's what you're expecting. Is that correct?
I think it's fair in part. We do own long-dated index-linked bonds in the portfolio. They're UK government bonds, as you say, linked to the rate of inflation, or as you say, expected inflation. But it is quite a small part of the portfolio, so less than 5%. So I think it's right that, and we would agree, that they will be a helpful asset in a world of ultimately what you've described, which is financial repression. So in a world where interest rates are capped because of government debt levels, which are the highest they've ever been, outside of World War II, we ultimately can't sustain that sort of interest expense. At the same time, that's being met with these more volatile and more inflationary-driven headwinds that economies and markets are having to face today. So that period of financial repression and the allocation of those long-dated index-linked bonds in the portfolios certainly tie up. But I would also say that there's a number of other assets in the portfolio which could work in a high and rising inflation environment. We've already discussed the derivatives, which were what in part drove the portfolio's return in 2022. I think commodities, though, are also a really important part of that, and another asset class that perhaps a lot of investors haven't owned for some time or are sort of under-positioned. And I think that's true both of maybe retail, but also institutional investors. And what you've seen over the last couple of years with the likes of precious metals, I think what you're seeing today with the oil price and then rising concerns around inflation ties up with the role that commodities can play through a period of inflation and potentially as another source of protection or as a hedge in investor portfolios.
So you mentioned precious metals there, and that was kind of the story really of last year, wasn't it? The rally in gold, for example, was incredible, and it performed more as a growth asset than a hedge. You obviously hold some. Are you nervous about gold in itself? Are you trimming? Are you adding to it? How do you see that in the portfolio?
So we have been trimming, but it's still a healthy allocation. So we had pretty significant exposure to precious metals last year. That was a key driver of our return in 2025. At its peak, around 10%, but that was across a range of different exposures. So at points, we held both platinum and silver bullion, but primarily the allocation we had was to gold mining equity. So at its peak at 10%, if you were sort of to adjust for that on a kind of beta basis, it would be actually be a lot higher. We started reducing that position really since the end of last summer, which, given what we know now and the beauty of hindsight, was a bit too early, but I think I'm okay with that. Partly it was about managing that position size. You never want a single asset to kind of completely dominate the portfolio's return. And I think it's also consistent with sort of how we manage risk. We're not attempting to time these things perfectly. So we have been reducing, but the reason for holding on to an allocation is I think all of the reasons that gold has performed well in the last couple of years are very much still in place. Why do we own it? It's similar to lots of other people. It fits with our view of the world and the risks we see around inflation volatility, fiscal policy that we've already mentioned is becoming much more dominant, geopolitical risks rising, and in that environment, real assets like gold and other precious metals we think can offer a source of diversification and resilience. I guess the point of difference perhaps is what we've held on to are gold mining equities. As I say, they're sort of the high octane way of playing the gold price. There's lots of operational leverage in those businesses, so they tend to react more powerfully in both directions to the underlying price of the metal. And you saw that last year, gold up sort of 60-70%, the gold mining equity index up sort of 160%. So a lot of bang for your buck there. Today, the exposure is primarily focused on mid and small cap gold mining stocks. And that's one of the benefits of managing an investment trust like Ruffer investment companies. You can sort of take advantage sometimes of those less liquid opportunities. And they're really the stocks where we continue to see a lot of value. The larger cap miners, some of the most well-known names in the space, have performed very well and have largely re-rated, and the valuations are probably a little bit more fair now. But we see a lot of value still at the smaller cap end of the spectrum. And the great thing about that type of exposure is you don't actually need to see the gold price itself to keep rising in order for those companies, we think, to perform very well. And ultimately, if gold can sort of just stay in a broad range, you should see those valuations re-rate and investors reward those companies for the significant amount of cash flow that they are producing.
I mean, some people might be confused listening to it if it's about a defensive kind of fund that you've got like small cap miners, which people think of as, very risky, right?
Yeah, absolutely. It's they are equities at the end of the day, and I think it's very relevant and important to point out that if we did see a sort of a correlation one event, equity markets falling across the board, we would definitely expect this part of the portfolio to, at least initially, do a similar thing. And it comes back to why we have a whole range in a different basket of protections, whether it's the derivatives, it's commodities, it's bonds, or it's things like gold mining equities. I think they still speak to that structural view of the world, and they should continue to perform as the gold price continues to perform. But as I say, it's about getting that portfolio balance right.
Now, you mentioned that you hold gold miners. Presumably that's because you don't have to worry about any kind of roll cost. If you get exposure to commodities via the futures market, then you do have to think about roll cost, which is the shape of the futures curve. As it rolls down, you're always paying away usually. So if you do get exposure to other commodities, how do you usually do it?
Yeah, so it comes back to the flexibility point. So we'll always look to focus on risks first and foremost. Once we've identified a risk or a sort of exposure that we'd like in the portfolio, there's then a secondary choice on, well, how do we want to get exposure to that? As you say, you can own, in the case of commodities, the underlying, or you could own the equity, you could even own some sort of derivative on the commodity. So gold is a good example of where we've moved between bullion and equities to the benefit last year. But to your point, Michael, that could go in the other direction at other times. With oil, for example, which is the other commodity we've got in the portfolio, it is held through an ETC. So exactly as you point out, Ramin, investors need to be really mindful there of the roll costs. Now, that's currently a positive roll yield on the oil, so that's not to one's detriment. But absolutely, it's a kind of a key consideration when investing in these slightly more esoteric or complex instruments.
Now, this might seem like a really stupid question, given that the Middle East is on fire. But where do you see the biggest risks right now?
Probably the biggest risk today, zooming out a little bit from the kind of day-to-day, is investors' assumption, perhaps, that the last few decades will be the same as the next few decades. Because I think, the example you gave is a good one, whereby the world is changing, both in terms of the economy, geopolitics, but also markets. And as a result, we think there'll be shifts across asset classes and asset class correlations. And we've already mentioned that in the context of bonds, but maybe thinking a little bit more about equities. I think you guys, refer to the kind of sell America trade. That's something definitely we've been thinking about as well. Since the financial crisis, the US was kind of the only game in town for lots of good reasons: tech leadership, earnings outperformance, energy independence, which is obviously relevant today, decent demographics, and they were pretty exceptional on the kind of fiscal side of things. So lots of good reasons, but also for lots of good reasons, I think that narrative has shifted or is in the process of shifting. Tech competition, the likes of China, you're kind of bringing that to the table. We saw markets respond to that when kind of DeepSeek was announced. AI disruption is obviously a kind of topic du jour. And you're seeing fiscal policy and expansion broaden beyond the US, the likes of Japan, maybe a bit in China, but notably also Europe and Germany. And then, of course, the obvious one that a lot of people kind of forget these days is valuations, good old valuations, much healthier outside of the US. So I think really that has rightly led to investors kind of questioning where they should put their marginal pound, whether that should go to the US. But I think the issue is that whilst the narrative is shifting, maybe the risk for investors is that their portfolios and positioning maybe haven't yet shifted because, again, as lots of us will know, global indices sort of look diversified on paper, but they are dominated by the US, over 60%. And even within that, pretty concentrated in a few names. 40% of the S&P is made up by a handful of the mega cap tech stocks. So great when it works in your favor, but if it does reverse and if this narrative kind of continues to carry pace, then maybe investors aren't diversified as they might like to be. And we've seen this year, such a good example of how quickly these narratives can shift. US tech having gone from pretty much invincible from the last 15 years to quite fallible. And that's happened really, really quickly. And I think probably a lot of investors are sat at home today are going to be wondering, well, have I sort of missed the vote? Is this already in play? Is it kind of too late given the outperformance of rest of world indices versus the US this year? And I will confidently say to them, no, I don't think they've missed the boat. I was looking at a chart yesterday which kind of plotted the kind of outperformance of the US relative to the rest of the world in terms of equities over the last 15, 20 years. And the year to date is the tiniest tick up at the bottom of the chart. So I really think that's a risk that investors should be focused on, but it's a massive opportunity. And I think it makes a lot of sense to balance exposure and seek opportunities elsewhere. So thinking about that diversification, not just within protection and assets and hedges, but within equities and growth assets too.
Now, one of the things that Michael and I discuss a lot offline is the impacts of AI, and you touched on it. Now, some people see this as a kind of dystopia that we're entering, where a lot of the white-collar jobs that are usually generating a lot of GDP are now at risk. So unlike the weavers' riots of the 1700s, 1800s, these are rich people who are going to be affected. And that could be very disruptive for society. Is that something you think about?
Definitely something that we think about. It's obviously a massively important narrative that is driving markets today and has been for the year to date, as we've discussed. I think our approach when thinking about AI is we're certainly not AI skeptics. I think to your point, we think about a lot and believe in sort of long-term potential of AI. But whether or not that makes it a good investment opportunity is kind of a different question. And it's sort of our jobs to separate those two things. So I think where we are a bit skeptical, or certainly have been, is on the kind of valuation side of things. You mentioned historical examples. A great analogy here is obviously the internet bubble, .com boom and bust of the late 90s. Absolutely real innovation. We all use the internet all day, every day today. But it wasn't necessarily a good investment opportunity at the time. And there was a sort of detachment from reality. So our approach when thinking about this whole topic, which is a huge one, is to kind of continue to respect the technology and the developments and the pace of that, but to keep discipline around valuation, sentiment, positioning of investors. And I think the concern right now is probably the shift that's going on with what were very capital-light businesses. Thinking about those big US tech stocks that are becoming pretty capital intense, right? So the hyperscalers are spending vast amounts of capital on building out the infrastructure required to deliver this shift. But it means that even if the technology succeeds, probably returns on capital are going to fall. And a lot of that is being funded by their free cash flow. These are hugely cash flow generative businesses, but that is not necessarily a sustainable thing. The pace at which they're spending, ultimately that cash flow is going to run out at some point. And that's really what you've seen investors punishing those companies for. And thinking about society, where we're going, how quickly this all happens, there's maybe two things that we're thinking about that perhaps markets are less focused on. One is the cost of this shift. To your point, if AI and these models, these agents are really going to start doing all of our jobs.
Oh man, they're not going to replace podcasters, and they're not going to replace fund managers, surely.
I hope not. I really, really hope not. But if they do, let's think hypothetically for a second. If they do, the cost of actually delivering this at scale is pretty significant. I think when referring to the idea of it's a $30 subscription a month to replace a human, I don't think is quite right. So I think there's going to be a much finer kind of cost benefit analysis to all of this. And then the secondary thing is, where are the bottlenecks, or where's the capacity? And I think particularly in terms of energy and power to deliver all of this. And that then kind of feeds back into cost, because if there are bottlenecks, there are constraints on power, and that pushes up prices, then that sort of feeds back to the cost of delivering this thing at scale. Thinking about turning that into opportunity, I think thinking about where capacity constraints are, where the bottlenecks are, is very relevant. And thinking about power and energy in particular, one place that's certainly not short of that is China. And I thought it was pretty incredible. China's managed to build out the equivalent of the US grid in the last 4 years alone. So that, to our minds, makes that a pretty interesting hunting ground.
So I guess from what you're saying there, you spend a lot of your time thinking about where the world's going to be in like 5-10 years' time and how you get ahead of that stuff. And I often wonder about the situation where you're right, but you're early and you move the portfolio and then you have to sit on a call, which you're so confident in, but you're just watching markets go the other way for 2 or 3 years. How do you handle that kind of situation as a fund manager?
Yeah. Well, I think the first thing to say is that we might have strong views and conviction in those views, but the portfolio itself is never trying to be right. Really, what we're trying to do is avoid ever being absolutely wrong. And that comes back to the combination of those kind of protection and growth assets. In terms of being early, yes, when we see a risk, because we're not trying to time markets, we will always try and build in the protection asset that we think we need once we see that risk. It comes back to wrapping it in offset, so making sure we can deliver the positive return either whilst we wait or indeed if we're actually wrong about those risks itself. But there's a couple of other things that I think are important for us as a fund manager at Ruffer in terms of our structure, but also our culture that maybe allow us to sit outside of the crowd for maybe uncomfortable lengths of time. In terms of structure, we're a private business, and I think that's really key because it means we're sort of free of the shorter term pressures of having external shareholders who might need to see quarterly results. And being owned by past and present employees really aligns us with time horizons with that of our clients. So we try to align interests there. The other thing is just about the culture that we have, one of sort of patience and I think humility. Having patience is getting more and more difficult in a world where sort of news flow is relentless and constant, whether that's on our phones all day or social media. And what really helps us there is kind of mix of perspectives and levels of experience within our investment team. So as you point out right at the start, I may be on the kind of fresher pair of eyes side of things, but there's a number of investors here at Ruffer that have invested through multiple market cycles, as I say, been with us since the firm started in sort of the late 90s. And that depth of experience combined with a range of different perspectives is really valuable towards that kind of internal culture of staying the course when it can feel uncomfortable. But also it's our job to help our clients do that and having a culture with our clients of honesty, transparency, helping to explain why we're positioned the way that we are and the risks that we see and what we own in the portfolio is really important to help our clients stay the course and not make the wrong decision at exactly the wrong moment.
Now, almost all of your trades are pain trades in, just picking up on what Michael said. So it must be really difficult for you communicating your positions to the investors in the fund. How do you do that? I mean, do you speak to people face to face? Is it via written communication? And is that frustrating, not being able to make your case sometimes because you've got compliance, you've got the marketing team who probably limit what you can say, and also what you do is very complex using derivatives?
Yeah, so I think we try and speak to our clients in lots of different ways. This is one of them. Hopefully this reaches lots of people and we're sort of articulating what we're doing and why. We write to our existing investors kind of quarterly. We're sort of always available for a conversation. We run quarterly webinars. So I think there's lots and lots of different ways. We also write a lot. As you point out, I think that can be a really powerful and slightly unusual form of correspondence, again, in today's day and age. It's something we publish every year, the Ruffer Review. The next copy is out is literally in a few weeks' time, which is basically a collection of ideas, thought pieces, discussions about our views of the world and what we're doing about it, which we basically publish in a book every year.
Can I just say that's really good?
Yeah, good. The cover's red this year. There's a sneak preview for you.
Sounds ominous.
Yeah, different color every year. But I think that's one of the best ways that our investors can really get a sense of who we are, why we do what we do, and how we do it.
Today's episode is sponsored by Lightyear, the investment app I open my 2025-26 stocks and shares ISA with. So why Lightyear? Honestly, it fits the way I invest. The app is clean and straightforward to use, and their stocks and shares ISA has no trading fees. They've also recently added fractional investing within the ISA, so you can put in exactly the amount you're comfortable with rather than having to buy whole shares. Not every instrument is available fractionally just yet, but you'll find a good range of popular ETFs priced in pounds, as well as US stocks, all within a tax-efficient wrapper. Do bear in mind that fund manager and FX fees may still apply. If you'd like to give Lightyear a try, use the code PensionCraft or follow the link in the show notes, and you could get between £10 and £100 in your general investment account. Terms and conditions apply, details are in the description. And as always, investing involves risk, and the value of your investments can go down as well as up.
So as we said at the start, you see your job as capital preservation, not to lose money. But there are years where it doesn't quite go to plan, right? So I know that 2023, for example, the fund was down. What happened and what have you learned from that?
Yeah, absolutely right. To acknowledge there has been a period of recent performance that was below the standard that we expect and didn't achieve the aims that we set out. And not just for ourselves, all of us, or most of us here in the investment team, are investors in our funds, but of course what's demanded and expected by our investors. 2023, as you point out, we didn't preserve our investors' capital. It was only the third calendar year in our 30-plus year history that we delivered that negative return, and the other two were less than 1%. So definitely a significant moment. I think really one main thing that occurred that year, we carried a lot of protection because we were nervous and cautious about markets and the economy in what clearly turned out to be a pretty benign period for risk assets. Now, that's not unusual. And I referenced that several times. Like last year, we carried a lot of protection, but we were still able to deliver a positive return. There's many years where that's happened. The source of frustration, though, was perhaps that the portfolio balance wasn't quite right. So the issue was really with the growth assets that we owned rather than the protection assets. They need to perform in an environment where that protection isn't required. And they didn't really fire as we would have liked them to in 2023. So it came back to a scenario of portfolio balance. 2024 was more frustrating. It was a flat year for Ruffer Investment Company. We had some good returns across the first sort of 3 quarters of the year. And then when sort of post-Trump's election victory, you had a very narrow, concentrated bull market in US equities and tech, to which we didn't have too much exposure for the kind of reasons that we've discussed. So when kind of reflecting back on that trickier period, I think the lessons really, or the learning was, and I guess this comes back to your question about how you stay the course, not to abandon our caution, but more to refine how we've expressed it. So I think we've got more diversity within our protection toolkit. We've been a bit more flexible, kind of switching between our growth and protection assets. We've been very dynamic in the portfolio the last couple of years, and staying the course and sticking to our views. And a lot of what were very unloved assets in the portfolio at the time has now been rewarded because lots of these themes are playing out, whether it's around the geopolitics, gold's resurgence, as we've talked about, a recovery in China. They've all been working nicely and have delivered much better returns for us in the last year or year and a half. As I say, last year, making money throughout the year through both periods of market stress and equity markets, powerful returns whilst carrying the protection. And again, the year to date has started strong.
In terms of idea generation, how do you go about it? Do you just sit around in a room and shout at each other? Or do you just read lots and then there's a kind of very thoughtful moment and you all kind of sit quietly and discuss? How does it work?
Do you just prompt Claude nowadays?
I'm pleased to say there's not a lot of shouting, which is great. The way we describe it at Ruffer is we have a democracy of ideas, but an autocracy of decision-making. So there's a lot of thought that goes in across the investment team. And who are the investment team? It's our 2 CIOs, Henry Maxey and Neil McLeish. There's 5 of us fund managers, myself and my 4 colleagues, who are kind of responsible for the overall portfolio. And then we have a range of professionals, about 25 others, who are really focused on particular asset classes. So whether that's the derivatives that we discussed, it's thinking about bottom-up equity opportunities, gold and commodities. And we are all responsible for sort of feeding into our process. So idea generation, but also crucially challenge, asking the difficult questions, challenging our CIOs, and making sure that, as you say, there is a room full of ideas and careful thinking. The reason we say autocracy of decision-making, though, is because ultimately our CIOs are responsible for setting the asset allocation at Ruffer. And that is very, very deliberate. We think that to be flexible, to preserve capital through stress and take advantage of opportunities the other side, the process needs to be set up to allow for very quick, clear decision-making. Because very often, I think it's more and more true now, given the speed of some of these corrections and sort of fleeting opportunities, that we can do that and do it very, very quickly to take advantage of opportunity. And so the best example I can give of that, perhaps, is the mini budget crisis in 2022, where you saw this huge sell-off at the long end of the gilt market because of those unfunded tax cuts. And there was a period of time, and when I say period of time, I mean a couple of hours, through which you could buy ultra-long dated bonds in the UK at very, very extreme prices. Now, if you've got a quarterly asset allocation meeting and a number of people that have to vote and agree on something in a room, those opportunities just simply aren't available. So we set up our process to allow lots of inputs, but to capitalize on moments just like that.
Okay, I've got a, I guess, kind of provocative question. So if I look at what I can see as your latest asset allocation, now correct me if I'm wrong, there's like 40 odd % in short dated nominal bonds and around 3% in cash. So in cash like things, there's like 45%, give or take. If I'm an investor, why would I want a fund manager to be charging a fee on like 45% of it in cash when I could just stick that in cash myself?
Yep. So a couple of things there. I think the first thing to say is we are ultimately paid to make an assessment of risk reward opportunities within financial markets. And I think it's fair to say that over the last couple of years, the reward that equity investors have been given for taking on the additional risk over and above cash has been very, very small. So that equity risk premium has been very, very compressed. So it's that observation that I guess initially sort of led us to have pretty significant allocation to cash and cash-like instruments, exactly as you point out. So I think it's our professional judgment of where the risk reward and where investors are paid to take on risk. But that is a moment in time, right? So that equity risk premium has been very compressed, continues to be, but at some point that will change. And sort of linking back to the last question, that can change very, very quickly indeed. And so we think there's a lot of value in having that kind of sufficient dry powder in portfolios, liquid assets, which are paying you a reasonable amount at this point in time, though that gets obviously less and less attractive as rates come down. But it allows us to take advantage of opportunity and redeploy that capital when we do think risk premiums are sort of more attractive, that we can do so very, very quickly. So I think it's a snapshot in time, it's correct observation, but ultimately it's our judgment and our experience that allows us to move in and out of risk assets as the kind of risk reward shifts and changes, and crucially that often comes in fleeting moments.
Now, the investment management industry is brutal, right? So if you underperform, people are very unforgiving. Now, you've structured Ruffer, at least one of the funds, as an investment trust, which means you can hold very illiquid investments. But if people vote with their feet, what actually happens is you have a discount to NAV, net asset value. And I believe that Ruffer's been buying back some of its own shares quite aggressively. So could you just talk about your policies around that and your reasons behind it?
Absolutely. So Ruffer Investment Company, as you say, investment trust, it's a permanent capital vehicle. And one of the benefits of that is the ability to own less liquid investments like the mid and small cap miners that we discussed. The other benefit, though, for investors is there is a board of directors. So it's a FTSE 250 company. Like any corporate, there's this board of directors which are there designed to hold us, the manager, accountable. And they clearly operate separately to Ruffer LLP, the manager. So the buyback policy is one of the board of directors. It's the directors of Ruffer Investment Company that make decisions around those buybacks. That is deliberately separate from the LLP, so as not to kind of derive any conflicts or prevent us potentially from buying shares in Ruffer Investment Company. And they've been doing it very significantly and in size. You reference, buying back shares. That was more than 10% of the company they bought back last year in order to try and manage the discount. The way they formally appraise that discount, it's not a zero discount policy. Some of our investors actually like the fact that we have this vehicle that can trade at a discount or a premium. They can sort of manage their exposure to Ruffer and kind of capitalize on that. But it is the case that the directors have stated that they are mindful of the discount when it sort of reaches mid-single digits, and they will sort of act in response to that. And one method of that is buybacks. The other thing that they've been doing, of course, with regards to the discount, is to create more demand for the shares. So making sure, coming back to your question about communication, that we are telling lots of investors, what we're doing and why, to create that demand for those shares, which will ultimately, hopefully, see us return to a premium, which is where we've often traded and typically move to during periods of market stress.
Why do you think it has traded at a discount for the last few years? Is it just a reflection of there's a couple of iffy years of performance and, investors chase performance?
Yeah, I think that's definitely a key part of it. Ultimately, what's going to drive that discount or premium will be the performance of the NAV and how we deliver versus our objectives. But I think it's also fair to kind of take a step back and look at the wider investment trust industry, which is, I'm sure you have covered, a lot of headwinds in the last couple of years, whether that's just quite explicitly kind of investor concerns globally around the UK. So passive selling of UK, the FTSE 250 is a third investment trust. So if investors are selling the UK, they're selling investment trusts. So there's a kind of macro thing going on there. There's obviously been lots of headwinds around fees and how they're sort of accounted for, and therefore demand in wealth managers and for other professional investors. There's also been huge consolidation within the wealth management industry. And so scale has become more and more important for our sector.
And maybe a last question. What keeps you up at night? You're running this fund for capital preservation and you have to think about all the things that can go wrong and make sure you're hedged for them. Now, maybe you can't tell me what you've missed because otherwise you wouldn't have missed it. But is there anything you think, oh man, if that happens, we may be a little screwed?
Yeah, I mean, I like you say, I don't know what I don't know, I suppose, is the key there. But ultimately, what we're trying to offer our investors is the fact that we're sort of up all night, every night, thinking about the things so that they don't have to. That's sort of really the core of our philosophy, is do the worrying on behalf of our investors. The danger for investors in the coming years will be that it looks very different to perhaps how investors managed a balanced portfolio in recent years. And I guess the challenge for us would be actually if that's wrong. And the next few decades are very similar to kind of that post-GFC or even post-80s period where bonds work. It's all about the US.
AI utopia?
Yeah, exactly. So I think in that kind of more conventional sense, I wouldn't expect the portfolio the way it's currently set up to perform as well relative to, say, an equity index. But that's really not what we're trying to deliver for investors, and it's why it can work very nicely sort of within a wider portfolio of more conventional approaches, and then us doing something just that little bit different.
Now, we talked about the worries in markets and how we can deal with it psychologically. If you want to join a community where you can discuss that with other members, it's really easy. Just go to pensioncraft.com/membership to learn more.
Okay, today's dumb question of the week. If markets usually go up, why spend so much time thinking about what could go wrong?
Well, as we mentioned, I think equity markets are basically like riding a roller coaster. And whilst in theory, we might think that we wouldn't run scared, actually the reality of severe equity market drawdowns can be really painful and really uncomfortable. And very often investors struggle to stay the course and will sell out at just the wrong moment because that's what ultimately makes a bear market. It's where all hope is lost. So I think, why bother? It's to try and deliver a more smooth, balanced return profile, one that helps you protect through those really difficult periods of market stress, but also helps you pick up some of the upside when skies are blue and the sun is shining on markets. We're often associated with bear markets and the really tricky periods when equity markets are falling. And I think that's fair because they've often been when our returns are very differentiated because the focus around capital preservation and avoiding those drawdowns absolutely is our focus. But I think it's also fair to say that we're not exclusively bear market operators. We're not always doom and gloom. We're absolutely thinking about the risks. But crucially, the benefit of preserving capital through periods of stress is that you can then reallocate the portfolio into risk assets. So it's the ability to preserve capital that then creates these amazing opportunity sets on the other side. And actually, if you look at Ruffer's calendar year returns, what you'll see is that, yes, we've got some very powerful returns through the tricky periods like .com. 2008 was one of our best years, 2022, but also the years subsequently. So 2009 was also one of our best years. And it's that willingness, I suppose, and flexibility to pivot a portfolio back into risk assets, having sold some of that protection, that can then also drive that long-term return, as well as keeping the power of compounding on our side. And one of the great things about this idea of regime shift that we've discussed, and there being a lot of risks and a lot of volatility out there, is that doesn't just create concern for investors, but it also creates a plethora of opportunity. You just need to have the flexibility to take advantage of it. I guess the other thing is that for most investors, they might only have access to the kind of traditional, conventional tools, so bonds, equities, maybe currencies. But what we do is try and have a wider toolkit as possible to manage from a variety of different risks. And it's true that through all the different market corrections that Ruffer has preserved investor capital, it's required a really different portfolio and really different set of assets. In .com, it was about maybe avoiding the epicenter of that risk around tech. 2008, we used currencies to do it. And as we discussed more recently, it's been about less conventional, more esoteric insurance-like protections. And usually those assets are sort of confined to sophisticated investors or hedge funds who charge very expensive fees and have high barriers to entry. But really, we're trying to bring that wide toolkit to a whole different range of investors.
I've got to admit, if I was a portfolio manager at Ruffer, I would lose control. For me, it would be like being in the tuck shop at my school, with all these sweeties around me. Oh my God, we can have swaptions, we can have single name CDS. We've got a whole gamut here. I just lose control.
Yeah, I think, so. I mean, it's an important point with such a broad, diverse toolkit. How do you know either where to start or where to stay focused? And what grounds us in what we do is, and the fact that it hasn't changed for more than 30 years, is we have a really simple, clear objective. It all comes back to preserving capital. It's first and foremost, what are the risks and what do we need to own to protect investors against those risks? And everything we do, all the discussions we have, all the debates, all the challenges, all the ideas, it's all anchored in that philosophy.
I suppose the other point is that not every investor is a long-term investor. Time horizons change, and you can't just wait out massive, long drawdowns in the equity market always.
Yeah, and a lot of people need access to their capital, right? So it comes back to your question, why bother? We might like the idea of putting our savings away, locking them up and not touching them for 50 years. Sometimes we're forced to do that if it's a pension and we can't access it until we're in our 50s. But the reality is that, as you say, life events happen and investors need and want access to this money, and they don't necessarily want to be at the mercy of at what point in time equity markets are rising and falling. So it kind of links back to why we do what we do, why even how investors use us within their portfolios, is it's a source of safe haven that when the money is needed, ultimately it will be there.
Well, Jasmine, thank you so much for joining us. That was great. And you fielded the difficult questions as well, which is always reassuring. But thank you for joining us. And Ruffer certainly produces that really fascinating report. And I strongly recommend people have a look at that, because in terms of a worry fest, it just can't be beaten. I love reading the Fed's documents and the ones from the IMF, but yours is great because it actually talks in more detail about markets.
Wonderful. Thank you for having me.
And here's to the next market crash. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.